just quick agenda. So if you have a question, but maybe don't want to interrupt, just put it into the chat, and Ashton or Chris, someone on our team is going to monitor that question and bring it back up. We'll try to have some Q&A at the end, as you can see here, but just agenda real quick. Want to talk a little bit about what we're seeing in the news. We know you guys are on that as well. Talk a little bit about PPP forgiveness. There's federal updates, state updates. There's PPP2. So now there's variations of this. Will there be PPP3? Don't ask me that. Employee retention credit, that's really the big one that's getting a lot of attention right now. And we will talk on it at a very high level, so you are kind of dangerous enough. We won't get into the mechanics of how to calculate it, but we will talk about what it is, how much it is, and just very high level how to gauge what the benefit might be. All right, so with that said, as with anything that we record, we are not liable for anything that you take and run from this webinar. Please, there are always exceptions, right? And those exceptions may apply to you. So this is very general. And if you do want to get into a specific discussion, please reach out to Ashton or myself about following up on any one point of this. So real quick, we covered at a very high level what's going on, but just the context. We always talk about the punchline. You can see here, it's one of my favorite Economist covers from July of last year. It's literally a factory just pumping out cash into the market, and that's certainly true with not just the individual stimulus money, not just with PPP, but the way that the Fed is buying up treasuries like crazy to keep interest rate low. There is money across the market right now. We'll talk a little bit about how we're interpreting that very shortly, but just high level points, right? Kind of all hearing it. I think the market's up today. So if you're a market watcher, you're probably smiling today. Jamie Dimon has a very well circulated shareholder letter where he's softly saying that the market's going to go gangbusters. For anyone that reads these things, it's very aggressive. So a lot of people are hot on growth as we're entering 2021. Certainly good for us. I've talked about the what we call the fiscal credit card. That's seeming to continue. If you listened to now President Biden last night, we're talking about a very aggressive, historic amount of government spending that is going to continue this run in the near future. Trend to online remains strong. I mean, I don't need to tell you guys that. I think Google had a record earnings report on ad sales. So we're not only seeing that come from large companies who are advertising online, which do make up the bulk of spending, but we're certainly seeing the small business level. And I'm sure there's folks on this call that speak to that more than I can. But yeah, capital is loose. And then the last point I'll make, not to scare anybody, but as a part of that, 2-point-something trillion spending plan, $80 billion is allocated to the IRS on a multiple year level to grow the Internal Revenue Service. I don't see this as a bad thing. I will say, I think that those of us who have been in audits or controversy have really wished that the IRS was more sophisticated in some ways, because a lot of the times, if you've ever dealt with the IRS, they have pagers. You can't email anything. You can't provide anything on a thumb drive. We've literally had to fax stacks and stacks of paper into the IRS in order to information exchange. So we expect an overhaul, not just of the technology, but of the staff, which again, I mean, do I think it's a bad thing to have a counterpart that's a little more savvy? I mean, I know the natural reaction clients have is no. we want them to be, not understanding. I guarantee you that's not the case. I think we want a smarter IRS that is able to, on a long-term basis, follow up with whether it's enforcement or whether it's just checking. We want a better IRS, and I know there's clients on this call who've had a headache just trying to get a simple thing updated. Ashton talked a little bit about, I'm just going to ask someone to If everyone can just check their mute button, that'd be great. But we talked a little bit about the news on PPP. By now, it should be news to our clients about the deductibility situation. That makes it extremely tax favorable. Like, I can't stress enough the fact that there is free money that you can also deduct expenses for. The IRS initially interpreted that to say that, hey, we've seen this before. Any grants that are provided to a taxpayer that are spent are never deductible. So that was the logic on which Congress had to basically override. Okay, there we go. Sorry, I had to take a second to mute somebody. So with that, I mean, Ashton, I don't know if you or Mike just want to take a second. I know I'm putting you guys on the spot, but there was a punchline with California PPP deductibility. Anyone want to take the credit there and speak on that? Nothing too much, but anyone want to deliver the punchline?
Yeah, I think Mike really wants to deliver the punchline.
Yes. Hi, everybody. Yeah, so one of the big exciting things this week is it looks like, I haven't checked this morning, but it looks like the governor is going to be signing a bill that passed through the assembly that's going to allow us to finally deduct the PPP at the state level, which is great because pretty much all of our clients, we've been holding on to your tax return and kind of saying, we got to wait. We're, we got our fingers crossed for something. And finally, that's come to fruition. And we are going to be able to finish tax returns. And at the state level, things are going to look better in terms of tax liabilities than they did a week ago. So got a lot of good news there.
Thank you, Mike. Yeah, we'll keep it short and sweet that way because, from where I stand, it has been such a headache because there has been outstanding legislation that has tried to call it conformity. Most major states have conformity, and California has been outstanding. Now, the deal isn't, the ink hasn't dried on the assembly bill yet, so we can't say that it's for sure, but all signs point to this week, next week, we should have clarity on that and we can take position. So what that means, if there's any ambiguity on it, is that we received PPP, maybe 100,000, and we spent all that 100,000 on wages, and it was forgiven at the federal level. And if we had $1 million of profit, well, we would have to add back that 100,000, right, to get to 1.1. From a non-conformity standpoint. So we are now able to get back to our federal income level on that same amount. So it is a very big update and something we're very excited about. Other things that we're seeing in the news, and I'm sure you're seeing, I mean, we're seeing it in our own client base, is we're seeing clients acquired. We're seeing the most amount of due diligence done on our clients' businesses. And of course, we're involved because we have to produce tax returns. We have to challenge the valuations. And we're seeing a lot of PE or competitors that are very large buy up a group of very small, talented businesses in the e-commerce space, particularly. That's probably the most active space where you're seeing private equity saying, hey, you know what, I'm going to create kind of a portfolio company, have economies of scale. I'm going to buy up all these $1 to $3 million e-commerce businesses that sell on Amazon or Shopify or whatever it is. So we're seeing a lot of capital spur acquisitions, and truth is, cost of goods and services are, at least anecdotally, also increasing, and something to just note. So you'll see a lot of that in the news. I think particularly it was Kimberly-Clark who, CPG company, they're saying, hey, market needs require that we are going to start raising the cost of your toilet paper, your soap bars, everything you see in those 3 aisles at Target. So anecdotally, those are things we're seeing. It's kind of the backdrop of kind of the context in which we say, hey, if you are in a glass tube where cash is flowing around you, the optimal strategy is to grab it. No moralists here, right? I don't care what you believe in government spending. It is a disadvantage to not take PPP if you still are on the fence. And as Ashton said, the deadline has been extended because of how favorable it is from a tax perspective. The second biggest credit that we're seeing a result from CARES is the employee retention tax credit. For simplicity, I'm going to call it the ERTC from here on out. But it is a 941 credit, meaning it's being claimed against payroll taxes. It represents cash coming back to the business. For those of you that work with us on the R&D tax credit, again, it's one of these things that we say, hey, it's a no-brainer. The question always is, well, what is the risk? And right now, it's too hard to tell you what historical audit rates are. But for the most part, I mean, this is a small business tax credit that has been established by Congress in order to pump money into the system beyond PPP to encourage employers to hold on to employees versus pushing them onto unemployment insurance. So anecdotally, again, that's why there's a disclaimer at the beginning of this webinar. It is a non-controversial, non-aggressive position. It is essentially algebra. It is addition and multiplication, and that is it. And that is claimed on the Form 941. So I'll just touch on it at a very high level. And again, just because I want to leave time for Q&A, we're going to be very superficial, and we're going to allow Q&A to maybe get into some more details, and then certainly one-on-one conversations maybe after this can get into specifics on what that credit is. So the credit can be claimed on 50% of the qualified wages paid, up to $10,000 per employee for wages in December 2020. I'll show you how that shakes out in a second, but the recent legislation in December is very significant because now you can claim, it used to be that you could get PPP or the ERTC. Two things happened with the consolidation bill that passed in December. One is that you can claim both, as I said, and then two, that the credit has been extended into 2021. So we'll talk a little bit about the differences of claiming it in 2020 versus 2021. But what we're seeing now as a result, now that the dust has settled on what happened in December, we're starting to think that even if you can't claim it in 2020, we'll talk about the tests in order to claim it. You are able to claim it. It's a lot easier to claim it in 2021. So even if it'd be great if you're in both camps, 2020 and 2021, understand that there's two different ways to claim it and qualify, but it's easier in 2021. And even if you are just in the 2021 camp, it is going to be a scenario where it would still represent cash back to the business for you. So no brainer. How much can you claim and do you qualify? And I'm just going to slow down here. One, because I need to take a drink of water here, but two, in case there's any questions so far, happy to field them if necessary. All right. We'll have to cut that out of the what we upload to YouTube. All right. So how much can you claim? So it's 10,000 per employee. And in 2021, the amount is 10,000 per quarter for the first 2 quarters. Now, those are qualifying wages. So that's more of kind of a tax point in terms of the inputs that get put in. I'll talk a little bit about what that actually represents to you. But who qualifies for small employers? I'd be under 100 employees. You qualify whether or not you were shut down, whether or not the employee provided services. Once you go over 100 employees, that's where you are only going to be able to claim the credit when you paid somebody to not work. So unpaid services for large, all services for small. It's a small point. 99% or maybe 100% of our clients have All right, fine. 99% of our clients have under 100. So I'm going to assume that to be the fact pattern for you. Wages. So there is a carve out for PPP. So you can claim the same person, but not the same wages. So if you received, and you have to do an analysis by employee, which is where the work comes in. If someone is paid $150,000 a year, you might know this already, but PPP only allows you to claim up to 100, and then you apply for forgiveness, and only 100 of that is going to be forgiven because of the PPP rules. So that allows you the remainder to qualify for the ERTC. Now, there's other reasons, perhaps that full forgiveness was not received. And in those cases, again, it's the non-forgiven wages that qualify for the ERTC here. So on the next slide, we'll get into this in a little more detail. But again, it's against 70. So employers who qualify, including PPP recipients, can claim up to 70% of qualified wages paid. What does that mean? It basically means you're taking a haircut off the total, and then you're carving out whatever PPP gave. I'll just repeat that so it makes sense. But you're basically taking a haircut, a 30% haircut off of wages, and then you're carving out PPP. How do you qualify? So there are two tests that exist for qualification. The first one is partial or full suspension by government order. You can see that. And the second is a gross receipts test. And that one's going to be a little hard to quantify without doing a model. So it's something that we can work out just with a simple P&L, something that you can calculate. But essentially, let's first talk about the shutdown. If your business had to shut down and the IRS has an FAQ, which I recommend, and maybe we can kind of link it in a summary email, but the IRS has an FAQ that goes into what qualifies as a shutdown. It's pretty liberal. So how many of us had to shut down the office and work from home? Okay, does that qualify as a shutdown? I'm going to say maybe. It's a gray area, and if you check the FAQ, there are conditions under which that fact pattern qualifies. 2020 is going to be difficult to calculate, to satisfy the gross receipts test, because you're going to have to show that gross receipts have dropped by 50% compared to 2019 in order to qualify. Now, some folks on this call might say, you know what, that's easy for us to do. So it's something for I think, you to assess. And I have a table here that shows, gross receipts in 2020 versus 2019. And you can see here that if there's a 50%, so you need to have one really bad quarter. Once you satisfy the 50% drop requirement, then you move into what's called the 80% test. So then it's, as you recovered, did you reach 80% of that revenue benchmark? If the answer is no, then that quarter still qualifies. And that means that you're picking up the quarterly wages that are non-PPP forgiven in that quarter. And that is the qualifying wage that goes into the 941 ERTC portion. Okay. So I know I'm covering a lot here, but I want the basic kind of broad brush strokes to make sense, which is you've got to have one really bad quarter, and then you're measuring kind of the return to normalcy. And once you hit that 80% test, in my example, I know it's pretty small, but once you hit that 80% threshold, you can see it happens in Q3. That's where you stop qualifying it based on the 2020 rules. Now, how is 2021 easier? 2021, you were allowed to compare rolling quarters. So I don't have a demonstration for that, but suffice it to say that you need similar to the PPP test, and we have calculators that we can even link. I think we have a calculator we can link that'll allow you to calculate that, to summarize it. But if you can understand how the 2020 test works, understand that 2021 you don't need to hit that full 50%. It's a quarter to quarter drop that you're trying to establish. So 2021 is much easier. So even if you're looking at this for 2020 and you're saying, okay, maybe we shut down for one quarter, but we canceled all of our payroll during that quarter. I don't know how much there is to qualify. I would say I still encourage everyone to look at 2021. In terms of calculating it, so again, qualifying wages are wages not forgiven by PPP. And our recommendation, the steps to take the ERTC is you do need to get PPP forgiven first, because that is going to be the carve out. You can't do the carve out without the forgiveness. So step one is take the PPP forgiveness first, and then the rest gets claimed on the 941. And I've alluded to this before, but if anyone were to ask whether it's better to, hey, I can get both. The deadline's extended for PPP. I can take it. By the way, we have clients that didn't get PPP in 2020 that are getting PPP1 funded yesterday. So it's still on the table. So if you're in a position where you're looking at two viable options, hey, I can get PPP or I can do the ERTC, PPP is better. It's better. You have better percentages, and it has better tax favorability. So it's deductible, as we discussed earlier, in a way that is going to have a multiple effect on wages paid in a way that the ERTC does not. So end of the day, Miguel, you said a lot, like what is the potential or the max, as I'm showing here, for my business? So back of the envelope calculation, 5,000 per employee per year in 2020. So 10 employees, let's assume you've got $10,000 for the full year on all of them, because it's a 1-year test. So $10,000, let's say 10 employees paid $10,000, $100,000 of qualifying. I've carved out my PPP so that $100,000 is remaining. That's going to be $5,000 per employee, $50,000. 2021 is better because it is $7,000 per quarter with the same test, 10,000. So if you have an employee that makes $40,000 a year, you didn't get PPP for 2021, so there's no forgiveness calculation on Q1, Q2. ERTC is going to be a good play for this year. So the ERTC is going to allow you to take, essentially, if I boil it down, it's $14,000 per employee of qualifying wages. So again, those same 10 employees can generate a credit up to $140,000. So I wanted to end with the juice and give you all the frustrating details beforehand, because I think, the way this works is it's going to take some momentum to calculate it out. This is new. For us, we've been doing R&D for multiple years, built a career doing that. This is a credit that came out basically, today from a tax practitioner standpoint. Didn't, it came out April with the CARES Act, but it's taken a while to really build it. And now we're just starting to understand these calculations, do these calculations. On our side, we work with or do webinars and CPE learning with other CPA firms that traditionally just focus on credits like this. So, as we've worked up to this, we're feeling really confident as we're understanding it that there's a lot of money on the table. And when there's money on the table, like I said before, there's no value in being a moralist. I don't care what your fiscal Keynesian, Hayekian views on government spending are. It's there, and it is intended to flush the system with cash. Everyone else has it. You should too. Closing thoughts. PPP is the best money on the market, hands down. What's the interest rate? 0. It's forgivable. You don't pay it back. ERC, should say ERTC, close second. It's something that, again, even if you're just a 2021 filer, in the example I shared, 2021 qualifier, 2021 is going to have a better boon for you than all of 2020. But again, remember the partial shutdown, There's some gray areas. We'll send out the FAQ link on what the IRS considers a partial shutdown. If any of the tests on 2020 sounded like hell yes, then I think this is, this should be something that you really spend time on today, tomorrow, next week, and get rolling, because the quarterly filing deadlines, they're rolling and you can go back and amend. But Q2 filing deadlines June 15th. Hey, we have a little bit of time, but you still got to go back and fix Q1. And then if you got any in 2020, you got to start getting those done. Now, what we do on our side is we do the math. We generate the PDF version of the forms, and then our expectation is that we can hand that over to your payroll company, be it Gusto, be it Paychex, be it ADP, and that there is a team there that can solve it. That said, some payroll providers are better than others, and I think you still have to expect that there will be some administrative back and forth with their teams. We've found that some of these companies still don't understand the credit, which is good news in the sense that, we've got some confidence that, hey, I really get this and I can explain it to you. But the bad news is, I'd expect them to know it better than us. And of course, if they don't understand it, it's going to be a bit of a hiccup getting it filed. Do they have to file a 941X amendment? Can they file it in time for Q2? Those are all things we're working through. And, I think we've got some other kind of just thought points that we're thinking about and writing about. But, as we enter this market of flush cash, the question is, how do you best allocate that cash? As we were talking about acquisitions, I mean, does buying a even smaller shop sound like a viable option for your business? Does, investing in technology or staff sound like something that is worth talking about? That's certainly where we're spending more time now versus just, hey, how do we save you cash on taxes? But it's something to think about as the market starts to be flush with even more cash. And as this is a hypothesis, so again, don't hold me to it. But as we begin to see the effects of inflation, which our generation just frankly hasn't seen, that would be my generation. What's going to happen to interest rates, cost of goods and services, just things to think through. So with that, I'm done. Ashton, back to you.
Yeah, so we'll open this up for questions. Feel free to unmute yourself and just ask away. There's not too many here right now, so we don't have to go the chat route. So if you have any specific questions or any slides you want us to go back to, now's the time. I know I have some questions, but I'll hold it for you guys. So feel free to ask away if anyone has questions. Otherwise, Miguel, I think you did a good job.
I'll take good today. Thanks, Ashton.
Well, then let me start off with my question then, because you mentioned, if it's below 80%, then you can get the tax credit. But then I saw in Q3 it was above 80%. You could still claim it. Can you clarify that for me? I think it was let me just put this on the right screen. Yeah, so in Q1, I understand, it's less than 50. Q2, it's less than 50. Then Q3, it's above 80. So I didn't quite understand that jump.
Good catch. I think good catch. I think let me rephrase that. The last quarter you qualify then is when the threshold is crossed.
Oh, gotcha. So anything after that, no. Okay.
Right.
That makes sense.
Right. So there's going to be some, we don't typically see, the tax business. We look at monthly and annual. We're all going to have to shift to being very comfortable with quarter to quarter reporting. So, for those of you that have dealt with revenue recognition on year end, you're going to have to start doing that. If you're close, if you satisfy the really bad quarter. Remember, I mean, if you didn't have a really bad quarter, like forget about it. Doesn't matter if you drop to 80% of revenue. What matters is that you drop to 50 and then you have that ability to climb up to 80. So having that clarity and having the ability to report on a quarter-to-quarter basis and having RevRec that says, hey, no, this, if you're on cash, I guess it's kind of easy, but if you're on accrual, you're going to have to part and parcel quarter to quarter. revenues and contracts and such.
Great. Linnea, let's give it about 15 more seconds. If no one has any questions, then I think we can wrap it up. Oh, we got one from Kareem. So do we have any information about SBA making PPP March 3rd rule retroactive to those who applied before the rule using net profits?
So, and let me, and Kareem, feel free to type your response, but are you referring to now the ability to calculate PPP based on gross revenue?
Yes.
Yeah. No, if you've already received PPP, the SBA is not going to recalculate PPP1. However, PPP2, if you haven't taken it, we didn't spend a lot of time talking about it. There is also a gross revenue test to get into PPP2, but PPP2 is going to be what is calculated based on gross. And if you want to chat further about that, I would just say that's probably an offline conversation.
Okay. Yeah, if anyone else wants to type anything in the chat or just unmute yourself and ask, feel free. If we don't hear anything in the next 10 seconds or so, then we can wrap it up.
Could you guys go over again the eligibility for the Ertc as it pertains to the first criteria of, full or partial suspension? I think you mentioned that's very broad, and obviously you can interpret that very broadly in favor of yourself. And I'm wondering if, what potential ramifications might there be in case of an audit or just overly broad interpretation of full or partial suspension.
Gotcha. So two things. One thing I'll do, Jason, is there are a few things I don't want to interpret from the IRS that come from their FAQ. So let me share that. I'll share that in the chat to everyone. So now, shutdown does mean a disruption to operations. So that's the tricky part. If you were already working, completely virtually, like for our business, I mean, we've got partners on East, Central Coast, and West Coast, right? So we operated that way before. We did have our kids come out of school. There's something there about that kind of disrupting us, but for the most part, we wouldn't qualify for a shutdown of operations. Is there a specific definition? No. But if you get it wrong, what's the cost of audit, an adjustment, and then depending on the size of the adjustment, so let's just say you get $50,000, that's the threshold where you start getting a 25% penalty. So that's the cost. I wouldn't really recommend being aggressive on that if it's very clear that your business operated very well. Now, could you make the argument that, and revenues would have to speak to it, there'd have to be a story there, but could you make the argument that everybody, March 15th happened, and you were disrupted, and you have the revenue dip to kind of show it during that quarter, right? Because customers are canceling. I don't think anyone was that productive, right, for part of March. So again, I would say look at the quarter. If you have a story, you can tell where maybe it didn't drop 50%, but it for sure dropped 30%. Then maybe that's a fact pattern you can get very clear on. But I think with all of these things, there isn't necessarily a paper trail. I mean, sure, if you have a physical present location, probably sent an email that said, hey, nobody come in. And that would probably be part of a paper trail. But, a lot of this stuff is going to be reasonable. So, can you reasonably have some kind of a fact pattern and a case that your business was disrupted and not able to operate as before, government orders. That's probably something that you can kind of work out on a case-by-case basis.
Right, because I'm sure some companies have like partial operations, flex time, people working from home. But then again, there's certain key interactions like trade shows and conferences that are lead generators and business and people development opportunities that could take because of the shutdowns. And, 2 major trade shows that we typically go to in a year could no longer really happen effectively. And on top of that, I guess it's a separate question. If a particular business was already on a growth trajectory to do much better in Q1 of 2020, but then a shutdown happened, and if you take into the growth story into account, it's pretty clear that once all the businesses adapted, that we were back in the growth trajectory. But then for that one quarter during the shutdown, like the growth trajectory wasn't the same, or whether it's like, no, you have to have actually gone negative as opposed to like had your growth momentum disrupted.
I get what you're saying. You're saying like the growth rate's negative, but like the percentage growth rate, right, month over month might be smaller than the previous month. So the delta of the delta is negative. But no, I would say that's probably it's probably getting a little too creative. But that said, I mean, I haven't seen anything about, but that said, that wouldn't necessarily mean that there wasn't a partial shutdown. Because if you look at the second link I sent, it's a FAQ specific to shutdowns. And the second one down, it's not necessarily direct. It's saying if your suppliers or vendors shut down and were unable to provide their usual services, then that would constitute a partial shutdown. So I would say read the FAQ. This is an area where I think if I could wave a magic wand, I would have 3 years of experience working on this and working with the IRS on it. But it's just so new. I kind of have to point you back to the source, at least for the purpose of at least in this medium.
Okay, thank you. Yeah, this is all very new to everybody, of course.
Gracious, thank you.
Great. Well, anyone else have any questions that you want us to ask or answer? Sorry. Well, then, Miguel, I think we are good. I think that about wraps it up. Well, thank you everyone for joining. We'll cut this out and send a recap in the next few weeks as well. I'll also send an email recap to some of you also. And it's been a pleasure. Thank you for joining.